And welcome to the Ramp Up to Retirement podcast with your host, Dan Reese. Dan, it's good to see you.
Yeah, great to see you. How's everything going?
It's going well, and I've got to admit, I'm intrigued. I was looking over the material before we started this recording for this podcast, and you and I spoke briefly about it because it's a concept I've never heard anything about. And I gather you're going to bring Brent on to spread light and understanding on the idea of the postmortem concept as it relates to that great big R word, retirement.
Yeah. And the whole idea is really we're going to talk through, people get excited about things. They get excited about retirement. They get excited about, you name it, it might be a trip or anything else. And so this idea is looking at it and saying, okay, let's assume it fails, right? Let's assume that it doesn't go like we think it's going to go. Why was that? And so it's this brainstorming to open up your idea to things. And so today we're going to take a slightly different approach. We're going to take a bit of a case study around it.
Okay.
And kind of walk through a couple in retirement and some choices they made in how that affected it, right? And so people can understand from a learning perspective as we look back, why didn't this work the way they thought it should? And so I like the concept. I actually discovered it in some business planning things.
Mm-hmm.
It was a consultant that kind of made us do this. And so it was like you create a marketing plan as an example. Let's we're all excited. We think it's going to be great. Let's assume it doesn't work, and look back at what might be the reasons.
It's interesting because, as you know, I used to produce a lot of live television. And when I was prepping for producing a live segment, I would be, my standard practice was, what if this doesn't happen? What if this goes wrong? How am I going to deal with it there? Is that kind of the same idea, Dan?
Yeah, I think that's a really good analogy. I mean, the thing is kind of looking at things from a different perspective.
Yeah.
Because human nature, when we get excited about something, we just assume it's all going to be good, right? Hey, I have this new job. It's going to be great. Well, what if my boss isn't as great as I think they are? You know what I mean? Taking a different viewpoint.
Yeah.
And it's exactly what you're saying in that example. What if the guest that you have on says something you don't expect or, goes a different direction?
Or the guest doesn't show up or, all kinds of stuff. Yeah. It's not an exercise in being negative. It's being proactive in terms of, I gather from what you're saying, it's an exercise in being proactive and thinking, hey, let's think this through and let's consider some alternatives here.
Yeah, it's hard too, because human nature is you get focused in on some outcome, whether it be good or bad, and it's hard to look at the other side of it, right?
Yeah.
So like, as we'll talk about today a little bit, but it happens both ways. Like back to the old thing of simple example, I'm going to put all my money, in cash because I don't trust markets. I don't trust this or that. Well, obviously, if you looked at it the other way, well, what happens if cash pays no interest for the next 25 years in inflation, right?
Yeah.
So it's that kind of a thought of saying, instead of just focusing in on your reasons for making the decisions you make, look at the other side of the coin. And so it'll be fun today getting into some of this stuff, and Brent's going to help us do that.
Well, he's good at that, so take it away.
Yeah. So Brent, how you doing?
I'm great, man. I'm excited to be here. This is going to be a fun topic. Really happy that you asked me to come on today and talk about this, because we know a lot of times with retirees, they don't get a do-over, right? You don't get to go back and make a different decision than you made a few years ago.
Yeah. And we know people learn better with kind of almost storytelling, right? So this is that idea of taking a hypothetical couple and walking through what they thought about and some of the decisions they made, right? So people can learn better and maybe make better choices.
Oh, for sure. And I think, on this, we're going to look back at a few decisions that were made that seem like small decisions, right? But these decisions really have impacted their situation, which is the case with a lot of times. Think about through the savings years, just increasing it by 1 or 2%, your savings rate, how huge of an impact that has, right? Well, it's the same thing when you go into retirement. Some of these decisions that doesn't seem like, oh, just a little bit here or a little bit there, or in this case, maybe a lot here or there, can make a huge impact on your success long term. And so I'm excited to talk about that.
Yeah, it's funny you bring that up, because I think both of us tell clients a lot of times that it's funny. It's not generally this great big thing that you do that creates a lot of success in retirement. It's a bunch of little things. And so I'm glad you said that because it reminded me of that as we talk to clients. Um, so let's get into a little bit about this family. So this family, and again, this is a hypothetical, right? We're not talking about any specific client or anything. It's a learning experience, but we're going to call them Mark and Susan Thompson. So if you exist out there and you're listening, we apologize.
Yeah, that's not you.
We're not talking about you.
Well, we're talking about some real life situations. I mean, these things have happened, but yeah, this isn't anybody in particular.
Right. So in their mid-60s, they're living here in Michigan. They have 3 grown children already out of the house working and things. Getting ready to retire, or they are retired, and they have $1.1 million, right, in savings, in retirement savings. Some in a little bit in cash and a lot in retirement accounts. Both have Social Security and everything. And one of the things that's going to be interesting as we look at this, as they retire, they walked into some really good market returns, right? Which can oftentimes be good or bad, right? Generally, it's good because you want to retire when markets are up. But one of the other things about them is that Mark and Susan, they've kind of always managed their own money all through life. They've never really had any advisor of any kind, no financial planner, anything like that. Fairly well educated, so they feel pretty confident that, hey, we've got enough money. We don't really need to hire anybody. We kind of understand markets and how we can invest and all those things. So, that's the other thing to bring up is they felt like help wasn't really needed for them, right? So, as we get into that, what kind of stands out to you about their journey at the beginning here?
I mean, I think it's a great point. Yeah, they didn't have an advisor throughout their whole life, and their situation seems pretty simple, right? I mean, they've done a lot of good things. They've saved consistently throughout their working years. They didn't have any debt, right? They stayed out of debt. They entered retirement with over $1 million, which is a pretty good start, to being successful. I think they had a reasonable spending expectations, and then the market kind of takes off and everything looks great. And what happened in this situation is they just had a little bit of a false sense of security, right? Like they thought, well, this market is the normal, right? And so they didn't really consider some of the things that were on the horizon.
Yeah.
They enjoyed, and that this is an area where I think a lot of people will make a mistake is early in retirement they had some pre-tax or tax deferred savings, a 401k that they'd saved to, and they had a bunch of money in the bank. So for the first couple of years they paid no income tax. They just lived off the money in the bank. Things were going along great, and they grew their nest egg during that period from about 1.1 million to a little over $1.3 million early in retirement. So they're like, this is great. Everything's going perfect. And then, some things started to happen that weren't going to really work out well for them. And they got a little overconfident in what the market was going to provide moving forward, and took a big distribution. They had one of their kids who lived in a little bit more expensive area of the country that wanted a home. And they wanted to help them and their grandkids live in a decent place. And I mean, all of us want that, right? We all want that for our kids and our grandkids. So they wanted to be fair. So they took out $150,000 and gave $50,000 to each of their kids. At that point, they were up $200,000. So they went from 1.1 to $1.3 million early in retirement. And they were like, hey, we can easily afford to take out $150,000. We're up $200,000. But they didn't understand, some of the taxes that would be moving on with that situation. They didn't understand the sequence of returns and things like that.
Yeah, it's interesting. I know a couple things you said about their case, which stood out to me. Not paying any taxes early in retirement, which is interesting because we've talked a lot about that because you're always going to pay tax. So in generally speaking, the longer you wait, the more you're going to pay if you're not proactive, right? And the other thing you brought up was how fast their portfolio grew early on. I mean, a couple $100,000. So they're up 20% basically, right? In that early stage.
Yeah.
which means more than likely their portfolio is positioned pretty aggressively, with quite a bit of stock in there, right? Maybe not as much in the fixed income and income producing investments.
Yeah, absolutely. And there's not anything necessarily wrong with that, right? As long as you understand what you own and what you can expect from those types of things in the short term and in the long term. But
Yeah.
when you don't have a clear understanding of that, it can create some problems as you're getting at, Dan.
Yeah, it's interesting. I'm noticing a couple of those things that you brought up, and hopefully that's good for the listeners to pick up on that. And one other thing I just want to note, because they took that big withdrawal out of an IRA, which taxes hadn't been paid on, right? I know we're going to get into that a bit, but that's interesting to me because you can't just take out the 150. You got to take out maybe even a little more than that to get the 150 if you want to do that to pay the tax man. So that kind of stood out as well. So I'm excited to hear what comes next, when maybe the markets are not so friendly.
Unfortunately, that's what happens in this situation. Is the mistake is that they take a big distribution without really having a solid tax plan that you got it. So of course they get hit with quite a bit of tax, but there's other things that happen. They get pushed up into a higher tax bracket because all of that was done in 1 year, right? That also triggered down the road some Medicare surcharges, which are referred to as IRMAA, which is kind of a hidden tax that's in there that they really didn't anticipate, which really in the future years drove up their living. Basically, it's a tax it's a living expense. They have to take money out to pay that tax down the road. And it also reduced the amount of money that they had that could grow in future years. And so all of this kind of starts to compound on them. And then of course, a lot of times when decisions like this are made, the timing of it, a lot of people would know what comes next is we have a market correction and then the market goes down. And so now they have to kind of start to deal with that as well.
Yeah, that's interesting because, I don't think a lot of people fully understand what you're just talking about, the Medicare. It's kind of like the base premium right now is about $185 a month, right? And then if you have Part D, which most people do, you have a little bit of a premium there, but that tends to be quite a bit less. But what you're talking about is if your income gets too high, all of a sudden that premium goes up, it sounds like.
Yeah, and there's just different tiers to that. So once you hit the next threshold, it goes up and it just keeps going up, and it can get very, very expensive. I mean, we're talking you could have as an individual maybe as much as I don't know the exact number, but it's a little over $5,000 a year, I think, and IRMAA surcharges above and beyond what you would have been paying. And so it's very important that you track your income on an annual basis to make sure that you're not exceeding those thresholds.
Yeah, and in the way that works, I believe, is that comes right out of your Social Security payment. So you'll get a nice letter from Social Security that says, "Hey, by the way, starting this year, your new benefit will be this, your net benefit." After we withdraw these, and I think that can really shock people, can it?
Yeah, and it's in this situation with the Thompsons, there's just an unexpected situation, and it that compounds itself, right? Because as I mentioned, the market drops a little bit. Their portfolio then, which was remember it was at $1.3 million, and they took $150,000 out of it, and then it's at 1.15, and then the portfolio dropped 20%. And so now they're sitting there where they were at 1.3 million and now they have $920,000. And you can guess what would happen because people in that situation, then they get scared. And so to stop the bleeding, most of us realize that, in normal situations, well, if the market's down, you would never sell out. But when you're scared and you're hemorrhaging money, basically, they're just seeing their balance continue to go down and down. What do? They go more conservative. We can't handle this type of risk, right? Because emotionally it's destroying them. And so they go more conservative, and then when the market does rebound, which it's going to at some point, they just aren't positioned as aggressive as they were ahead of time, and they don't get that bounce back up of the return. And so all of these things their income plan, their investments, their tax plan. It's not coordinated, so they're just allowing things to happen to them based on fear and emotion.
Yeah. Yeah, which is pretty common, right? When you don't have somebody working side by side with you to reassure you, like an expert in this area, to make sure, number one, you know what you can do, like those gifts to the kids. Like, with a certified financial planner might have said, hey, this probably isn't a great idea because this is not that you made extra money. This is a sequence of returns where next year, and in this case it happened, you may lose a chunk of that with a down market. And so, yeah, that's really great that you brought that up. And I like that, we're human beings, right? So when you get that and you have uncertainty, what starts happening with all that emotion, I think most of us know we don't think as clearly, right?
Right.
So we go into that fight or flight and,
Yep. Exactly. Exactly, Dan.
yeah. So no, that's really good. So let's talk next, so now let's just assume they've got that point where they talk to other friends and said, hey, I work with Brent, you know what? And we haven't had any of these types of things happen to us. We've got a really consistent plan we feel good about. So they decide to give you a call. And so now what would happen at this point or differently now that they've got somebody that they can qualify that can help them make decisions moving forward?
Yeah, and I think, a lot of that starts just with building some structure around the plan, right? Like, let's figure out what it is that's most important to you. What are you trying to achieve? And then we can start to build an investment strategy around your goals, right? And what you're trying to achieve to help you do that. And in this case, what we did is we said, okay, here's your income needs moving into the next 3 years. And so we positioned some assets in different buckets, right? So we have some near-term money, then we have a 3 to 4 to 7 year bucket of money, and then we have a long-term growth bucket that allows us to structure their investments to help them achieve the things that are most important to them and in a tax efficient manner. So we end up doing a few small Roth conversions. And fortunately, in this situation, Susan hadn't taken her Social Security yet. Mark had, but that's okay. We worked within it and we were able to maximize her benefit, which increased their future income significantly. And also, if one of them happened to pass away, they have one benefit that's maximized that really helped their situation. And then we were able to kind of give them peace of mind, knowing that we had this structured investment plan that was going to support the income needs that they had moving forward to help them be successful and help them make really, really good decisions moving forward.
Yeah, it's funny you bring up the bucketing. We've done a lot of research on that. And one of the things I think we've found and research shows is by setting money in specific buckets for different time frames, it lets people relax or it helps people relax a little bit more when they see that volatility. Because the money that's more volatile, they realize, oh, I'm not using that for quite a few years. So it's easier to let it sit and let it do its thing, right?
Absolutely. And if you go back to the beginning of this plan, if they had that, even maybe the gifting would have worked. It maybe not exactly the way they had it structured, but if that was one of their goals, that could have been a separate bucket, right? That was there, that was available for them to use. And if that's their wishes and that's what that is really important to them, then we would want to build that into the plan. But when it just happens because, well, the market's up, I'm sure we can afford this now, that's really not a good way to make that decision. And so putting those things in buckets, as you're saying, Dan, it changes everything, right? Because their perspective on all of those different buckets is different.
Yeah. Now, with that, though, I think part of their situation, because some of the decisions that were made up front, was there an effect long term on the income that could be provided out of their resources?
There was. They had to change, and so they were originally planning on spending about $90,000. So that's after tax money, and it's down to around $72,000. So $6,000 a month. They still had that's a pretty good amount of money to spend in retirement. And then what we were able to do is build some guardrails, if you will, around that income. So, you're getting $6,000 a month spendable. If the portfolio gets up to a certain level, then they can get a raise, right? And that can continue to go up, which hopefully it will as time goes on. If we have another market event and it gets below a certain amount, then there may need to be a little bit of a decrease. But that structure allows them to have a lot less anxiety, right? They're not worried about it. They know this is the income that they're going to have, and this is how it would change under certain circumstances. And that helps them feel confident in making any other decisions that they're making, because it's on sound logic as opposed to just what they feel like doing at the given time.
Yeah, it's funny. It goes back to, and we talk sometimes about, I know you have a poker league you're in and things like that. And I always think of like people that go to Vegas and gamble, like they make a bunch of money and it's like, oh, I can spend that, not realizing if they keep playing, they're probably going to lose some of that money. Right. And,
Absolutely.
and it just reminds me of that, hey, we're up. We can, help our kids out, which who doesn't want to help their kids out. Right. But
Right.
yeah, one of those things that you got to remember, thinking long term, that this is just 1 year or maybe 2 years of returns, not 30, that you're going to have in retirement.
Yeah, I mean, Dan, that's such a great point, because if you think about it, if it had gone the opposite direction, so say early in retirement, this couple, they're doing it on their own, and the market went down 20%. Do you think they would? They're smart people. They wouldn't have said, "Oh, this is a perfect time to give away $150,000." They wouldn't have made that decision. But what they didn't understand is that was going to happen at some point in their plan. Like the market was going to, it doesn't just go up. We all know that, right? And so that sequence in which that happened gave them false confidence, and it led to a bad decision.
Yeah. Yeah, it definitely, and especially if you've been going through a period of good returns in the market, like we've had the last few years, pretty good returns. People sometimes do think, oh, it always goes up, and it's easy to get sucked into that. And then when it does go down, it's even scarier because you're not used to that, right? Nobody likes seeing their balance go down on their statements and things. So, hey, well, let's just talk a little bit. If you just had to boil this down to a few kind of lessons for listeners, what might those be?
What you were just talking about is that just because the market's up, that's not free money, right? You can't assume that it's going to just continue to go up. And you really need, if you're taking big withdrawals from your portfolio, you need to understand the tax implications and the long-term impact that that's going to have on the sustainability of your plan. And so what I would tell everyone is that you really need to understand your investments. And your investments are the foundation that everything else is built on, but it's built on your goals and what you're trying to achieve. So you want to make sure that your investments are positioned to help you achieve the things that are most important to you, which in most cases is your income plan, or if it's giving is built in there, or travel. Like all those things should be accounted for and part of a plan, and your investment should support that is. And then you always have to consider the impact of taxes on your plan, and make sure that you're paying the appropriate amount and not more taxes than you should be paying.
Yeah, those are good points. And I think of going back to that, kind of postmortem idea. Like the thing is, I know we do a lot of this. Like if you want to gift, one of the best ways to do that is like say, okay, let's assume we do this. Now let's put that scenario into our plan and then do a stress test if we do that. So if we give this money and then we have that big downturn in the market, how does it affect our plan? Does it still work, or are we going to have to reduce our spending, for the foreseeable future? So, that stress testing, if you want to talk just a little bit about the value of that stress testing for people.
Yeah, I think that goes with what you're getting at. And what I was mentioning is that like a stress test just looks at all these different market conditions, and it is laid over your goals, right? So a goal would be how much you need to live, and then whatever those other goals are. If you want to travel a bunch, if you want to buy a second home, if you want to gift to your kids, or a combination of those, we want to build that out in a structured manner that says, here's what it's going to cost you to do. and then subject that to different market conditions and show you how much those decisions are impacting your probability of success. And so, yeah, I mean, you just have to have that to give you the confidence to make those decisions, because who wants to sit around? I mean, I talk to people about this all the time. No one wants to go on a vacation that they're not sure if they can afford. Right.
Right.
You don't want to be in a spot where you feel guilty about giving your kids money, or you feel like, oh my gosh, did I just screw up my whole situation? You go on a vacation where you know you can afford it, you can have a lot more fun. You give a gift that you know you can afford, it feels really good. But doing those things without knowing the consequences of it is going to lead to a lot of stress and anxiety, which you just don't want to have.
Right. Yeah, and to kind of wrap up, I mean, one of the things that I think, and Brent and I talk about this all the time, some of our best advice is go have a conversation with a certified financial planner. And what I mean by that is that it's okay if you want to do it yourself in retirement, but it still is a good idea to go in, have that conversation with a certified financial planner and talk to them about, hey, this is what I'm thinking. Is there any holes you see in this idea? Get some perspective for someone that does, with someone that does this for a living, because, really it doesn't cost anything to do that, to sit down and have a conversation and just talk about some of these things. And you may learn a whole lot and realize, you know what, maybe it would help us, right, Brent, to have that help along the way.
I mean, there's no question. And like you said, I mean, even if you don't end up working with them, I mean, wouldn't you rather work with somebody who initially, even just to pick their brain, of somebody who does this every day, right? We have a lot of experience to draw on because we work with people who are approaching retirement or in retirement. And we see some good decisions and we see some bad decisions, right? And so we want to help people make really good decisions that they can feel confident in.
Yeah, no, I think there's no question. I think the best thing I think the best compliment that you can have as an advisor, and when we hear this, is I just feel so much better about what I'm doing, and I mean, that's enough to make you smile, right? Because, that's our goal, make you feel better about what you're doing, more confident, like you're talking about. So, Brian, I really, really appreciate your time today. I think this has been really insightful, and I think the listeners will get a lot out of it.
Oh, it's my pleasure. I'm always happy to talk about this stuff. I love it,
Yeah, no, this was a really terrific and interesting conversation because it's funny, and it's not the big things can certainly screw you up, but it's the little things that can really undo you because you don't think about it. And to that end, Dan, if people are listening to this and thinking, I like this approach and maybe I ought to reach out to Dan and Brent and have a conversation or at least a review of where I am, maybe gain some insights, and how do they reach out to y'all?
Yeah, they can contact our office, 517-783-1695. Information's in the show notes as well. Going to our website's a great idea. One of the things we'll do if you're a listener to the podcast is we've got a tool that we use it's called Asset Map that we'll create for you. Even if you're going to do it yourself, we think it's very, very valuable, and we can create that for you through meeting with you in the office. And that can help identify some of the issues we're talking about before you start off in this retirement journey. And so, yeah, we highly recommend it. We've had countless people tell us that tool has really helped them better understand their finances and where things are, looking and where they're going. And so that I can't emphasize enough that this is lifelong learning. Retirement is different today than it used to be. And it's really good to understand all these pieces that we talk about and start that journey. You know what I mean? Go to a website. We've got all kinds of good information at averywealth.com. Give us a call, sit down and have coffee. I mean, honestly, talk a little bit about the things you're thinking about. We're happy to do that. We love meeting new people, and it's fine. Like if you decide you want to go a different direction, we're going to be happy to meet you and supportive of whichever way you go. But that's our best advice. Just, dip your toe in the water and start trying to learn some of these things.
Yeah, not to add, for those of you who are listening who don't have a financial advisor, at the very least, give Dan a call, because that conversation doesn't commit you. Sitting down with Dan or Brent doesn't mean I talked to them, so now I have to be a client. You may talk to them and think, okay, that was interesting. But you also might talk to them and find out, you know what? I could use some help. And I would encourage you to do that. The other thing I would encourage you to do right now before you forget about it is hit the follow button. Because if you are not a subscriber, that follow button makes you a subscriber and you will never miss another episode of this podcast. So, the other thing, you know what, while I'm thinking about it, if you are listening to this podcast and you find it interesting, you find it useful, tell people about it, please. Because word of mouth promotion is absolutely, hands down, the best promotional tool we could ever ask for and we could ever receive. So until next time, I'm Bill Tucker. On behalf of Dan, Brent, and everybody at Avery Wealth, thank you for taking the time to listen. We'll catch you next time. Thank you for listening to Ramp Up Your Retirement. Click the follow button to be notified when new episodes become available. Visit our website at www.averywealth.com or give us a call at 517-783-1695. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Avery Wealth. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in Ramp Up to Retirement with Dan Reese are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Guests on the show may not be affiliated with CWM LLC. Views and comments by guests may not be representative of CWM LLC. Investment advisory services are offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.